The following is an update and technical analysis on the US equity and bond markets based upon multiple time frame intervals where I had mentioned on the 26th of October 2023, we were testing critical significant price support levels correlated with the much larger picture within the weekly timeframes, and that it would be ideal for a great long trade setup in the risk reward analysis for the bullish case scenario. We had positive, beautiful, looking positive divergences really amongst all four technical momentum indicators with confirmed bullish crossovers here in the moving average convergence and the stochastics 1033. Watch for a break above the 14,297 price resistance to enter the traditional gap on a complete unfilled back check of the gap, with additional support down below at the 14,043 price support. And it was an offset looking primary channel, beautiful reaction, airy lows and reactionary highs really across that entire sphere to gauge in and for a potential bounce. We had that whipsaw like reaction, we had that false bear trap, we had a shakeout move, one of the most beautifully defined shakeout moves, back tested the bottom of the primary channel and was heavily defended by long traders and or bull traders. And here's the update. And the entirety of that trade thus far was good for, call it a 6.71% move to the upside. And in a single index, that is a very large move, with the week marking a significant upturn for both stocks and bonds, notably the best week so far this year. And the surge was propelled by Federal Reserve Chair's Powell's unexpectedly less hawkish approach within the FOMC meeting. The release of weaker than expected macroeconomic data acted as a momentum catalyst. Again, when I define how the charts manufacture the headlines, this was it. Aligning with the concept that negative news can oddly fuel positive reactions within the equity markets, these combined factors sparked a massive short squeeze in both stocks and bonds. A noteworthy highlight, one of the biggest highlights during this period, was the remarkable 36 basis points drop within the 10-year Treasury yields over the past 3 days. And this decline stands out as one of the most substantial moves within the last 12 years, excepting the COVID flash crash. And here we are testing the 15,102 price support. And I have added a new primary parabolic uptrend line with significant reaction if and when long traders and or bull traders hone in on, correlated with dual daily price support of the 1974 price support. So bull traders, long traders, they need to defend this key inflection point really at all costs to sustain a momentum rally to the upside. Whereas short sellers, they want to see a solid hourly candle close breakdown there. I'll put in a potential divergent high with RSI divergence, a potential RSI and MACD divergence. Again, very aggressive short trade setup. And I believe that would usher in a wave of selling if and when we go on to retest and or backtest, break that level, break down below that key inflection point. Whereas again, long traders want to defend this parabolic uptrend line, go on to retest the 15,193 price resistance, and that will stand as the most imperative hourly 60-minute interval key inflection point, really at all costs, in my opinion, only notable of a primary trading range, which I would believe would issue in just a much larger squeeze to the upside if and when we go on to take this key inflection point out. Then you're going to have a ton of shorts continue the trend and the big emergency rush exits in an all-out panic to cover their positions. Zooming you out to the daily interval, the much larger picture to the NASDAQ 100 futures, and we are about to test a primary downtrend line that I have been hyping and harping about for months on end, where we actually caught this short trade setup. We ended up back testing it, where I had offered an additional great risk reward ratio short trade setup to the downside, and that was met with a fury of selling on a back test retest of the 200-day moving average in confluence of the 14,297 price support and the 382 fibs retracement, and that was bid heavily to the upside. And here we are retesting it once again. I would offer as an aggressive short trade setup where we have the 786 fibs retracement and the 15,281 price resistance hovering up above, giving you the utmost, most valuable short trade setup on a great risk reward ratio, a potential move to the downside. Make no mistake about it. In the near term, we are in a near term downtrend. Make no mistake about that. Bull traders, long traders, they want to see an infused big breakout green candle close above that key inflection point, ushering in a wave of buyers to retest the 15,718 price resistance and a much, much larger primary downtrend line, call it a multi-year, dating back since the reactionary highs of 2021 of the all-time highs there. And that will be the ultimate, I believe, the most valuable short trade and or short trade setup really at all costs there, where short sellers, bear traders would need to really hold that level key inflection point off to spur any health back into the trade. Whereas again, bull traders take this level out, you're going to have a squeeze on a much higher prolonged rally to the upside, only tearing apart and potentially surfacing out to new all-time highs with no resistance up above. Taking you out to the much larger picture of the US 500 futures, S&P 500 futures based upon the daily interval, and we are testing resistance as of now, called the 43.63 price resistance. We have the undercut of the 50-day moving average, called a dual line of support, but there is a ton of resistance up above the 618 fibs retracement, call it 43.96, and the 44.22 primary downtrend line. Again, same picture here, where we have yet to go on to retest the mechanisms of that price resistance correlated with the additional price resistance up above. Just a ton of a resistance. A very hazy picture there for the US 500. But again, bullish traders, they want to power fuel, continue the momentum of this fuel here with confirmed crossovers here and bullish crossovers here in the moving average convergence, going on to retest its zero line threshold. And when we do, if and when we do, that will imply the greatest risk reward ratio for a short trade setup move to the downside. If and when we go on to have that stronger, much more bigger rally to the upside, only offering a great risk reward ratio move for the short sellers there. Again, bull traders will want to power through all the lines of resistance up above here, taking out that primary downtrend line on a potential backtest, re-challenge the 786 fibs retracement and the 45.28 price resistance, much larger price resistance up above there. And that will be the ultimate key inflection point to watch and the ultimate short trade setup for any short sellers. Zooming you into the 240-minute interval here on the S&P 500 futures, and we are testing resistance up above the 43.63 price resistance, 43.95 up above. Is for any active and or day traders. This is a primary downtrend line with a multitude of reactionary highs here to go on to a potential reflect and or re-challenge that key inflection point, offering again the greatest risk reward ratio for any short sellers and or bear traders to defend heavily at all costs. Whereas bull traders want to see a solid big breakout above 240-minute interval, a breakout above solid green candle close on a re-challenging of some upward resistance levels if and when we go on to retest that key inflection point. You have stochastics 1033 powering above the 85 threshold, a very healthy looking sign with the moving average convergence breaking out above its zero line threshold, as well as the oscillator, just health being poured right back in this short squeeze setup. No indication of any sell signals and or breakdowns and or negative divergences. So again, very risky for the short trade setup in my opinion, whereas the ball in the court lies heavily with the bull trader. Taking you out to the US 2-year here on the daily interval, and we are testing this primary reactionary uptrend line, call it multi-year price support off the May 2022 lows. And this is a key transitioning point where short sellers need to defend heavily, really at all costs, to avert a breakdown sell signal within the yield, which would then transpire into a bunch of longs, bull traders to hone in on to short the 2-year on a breakdown retest of the 236 fibs retracement, call it the 464 price support, with the confluence of the 200 exponential moving average. And that will be the utmost big key inflection point to watch. This and the risk reward ratio lies heavily to the short side and on a potential rechallenging of the bottom of this primary uptrend line. Make no mistake about it. I've been covering the US 2-year for quite some time, where we've had negative and bearish divergences really constructing amongst multiple indicators with near-term divergences as well. They have been constructing going back since March, beginning of the year here, with confirmed bearish crossovers here in the moving average convergence and a stochastics 1033 that has basically just collapsed. Make no mistake about it, off this minor uptrend line, that is as good as a breakdown sell signal as you could possibly get with a back test, and only testing major price uptrend line support resistance that needs to be defended heavily by short sellers, really at all costs, to avert a much larger breakdown sell signal in an all-out rush into bonds, a re-challenging of the 426 price support. Taking you to the belly of the curve in the US 5-year. And we are testing, again, major price support level, a major primary trading range, the top of the primary trading range that needs to be defended heavily, and really to the button right off the 445 price support was bid heavily, especially if you're an active and or day trader. The talk about the short trade setup on a prolonged potential move. This is, make no mistake about it, this is a complete breakdown sell signal off this beautiful looking bearish rising wedge pattern. Multiple reactionary lows right across that sphere, and just the velocity of that breakdown really signifies how imperative that inflection point was, with negative big divergent high here, negative and bearish divergences really amongst all 4 technical momentum indicators, and the waning of the effect of the momentum is just breaking down, collapsing before our eyes here. Which again, if you were short the 5-year, watching that key inflection point, that move has been good for a 6.42% drop to the downside, shorting the 5-year yield. Taking you out to the US 10-year off the daily interval. This is the most pivotal inflection point, highly correlated to the housing market and the overall demand and supply for US government bonds. And here we are testing and breaking down below this primary uptrend line based upon the August 2020 COVID era. Call it multi-3-year price support level, and we are testing that level as of now. We have slightly undercut that key inflection point. It will remain to be seen if short sellers step in now to avert that breakdown sell signal in the yield, further pushing yields to the upside. This is a great risk reward ratio, I believe, for any longer at the long end of the curve for short sellers to begin positioning on a scale and end process for a prolonged potential move to the upside in the price of the yield. Taking you out to the US 30-year based upon the daily interval, and I believe this is the most pivotal, most greatest looking chart when it comes to the risk reward. I would call an aggressive short trade setup on the 30-year yield. And here we are testing the minor primary uptrend line based upon the July reactionary lows. And here we are successfully completely bid off that yield right off the 50-day moving average, really to the button, closing in right up above that primary uptrend line. So watch that key inflection point. Short sellers, bearish traders, they need to step in now to avert a continuous breakdown in a bullish trend for the US 30-year. Whereas bull traders in the 30-year want to see a solid additional daily breakdown sell signal below, ushering in a wave of buyers to retest the 1 fibs retracement, call it 458 price support, and then additionally a rechallenging of the 786 fibs retracement, call it 4.382 for a move to the downside. And additionally, we have this primary reactionary major uptrend line off the April 2023 reactionary lows, and that will be the ultimate line in the sand, in my opinion. These are major transitioning points really across the board here that needed to be deflected. With a crashing yield move to the downside, and the entire yield curve is starting to move with additional breakdown sell signals. After all, do not forget that in 1987, Black Monday, it wasn't solely stocks that plummeted. Bond yields also saw a significant decline down with them. Just picture the substantial impact this could have on financial conditions, prompting swift action from the Fed to restore stability.